Let's take a look at how the bond market returned through the month of May using Asset Camp. Overall, the U.S. bond market, as measured by the Bloomberg Aggregate Bond Index, returned negative 0.7% for the month. Corporate investment grade bonds were flat for the month. U.S. corporate high yield had a positive 1.7% return, so dramatically outperformed U.S. Aggregate Bond Index, while the worst performer was U.S. Treasury long Treasury bonds, down almost 3%. Bond market returns are driven by changes in interest rates. And if we take a look at how yields changed during the month, that will explain the performance. You'll see, comparing the May column to the April column, that overall yields for the U.S. aggregate index increased about 20 basis points, whereas for U.S. corporate high yield, they fell about 40 basis points. So those falling yields, prices increased, and then U.S. Treasury long increased almost 30 basis points in the month. Although yields changed for the month, overall yields compared to the beginning of the year haven't changed that much. Let's take a look at that. If you look at the December 2024 column versus the May 30th, 2025 column, you'll see not a big difference in terms of overall interest rate changes. U.S. aggregates down about 20 basis points, high yields about the same, long treasuries up about 10 basis points. That 20 basis point drop in the U.S. aggregate year-to-date has boosted returns a little bit. Let's focus on year-to-date returns to wrap up our bond market review. Year-to-date, the U.S. aggregate, corporate investment grade, and high yield have all returned about 2.5% or so, plus or minus 10 or 20 basis points, whereas U.S. Treasury long only returned about 0.5% year to date. Now, there's been some concern that Congress will pass a big, beautiful bill that will stoke higher deficits, higher debt levels. Overall, though, if we look at yields for longer-term treasuries, they're higher than they were a couple years ago, but they're certainly not as high as they've been in years past. Let's take a look at that real quick. You'll see here U.S. Treasury longs around a 5% yield as of the end of May. And we have to go back to really 2003 to see yields at that level. But they've certainly been much higher back in the 70s, 80s, and 90s. So we're monitoring the progress of that bill on Asset Camp, and we'll certainly address it there in our monthly investment strategy report to see if we could see a blowout in those longer term yields. Any questions on the bond market? Leave them below.